And we think that roughly 50% of the S&P 500 is at risk of creative destruction. Some more, some less, but 50%. And now we see auto manufacturers scrambling, and we would say they're scrambling for dear life.
Hey, I'm Steven and this is Solving the Money Problem. If you're new, welcome. If you're not, welcome back. So in this video, we're hearing from Cathie Wood of ARK Invest with an urgent warning to stock investors. And I'll be honest guys, every time I use the word urgent and warning in a video title, I kind of want to punch myself in the face. But that is the most accurate description I have for what Cathie Wood has to say to stock investors. We'll hear her thoughts about the enormous disruptions taking place, good deflation, the future of the automotive industry, artificial intelligence, contrarian investing, and the huge amount of inevitable destruction just around the corner in the stock market. So let's get into it. And by the way, since I know there's a lot of crypto lovers watching and people who like free stuff, it's your lucky day. For a limited time, you can get up to $250 in free crypto bonuses when funding a new account on BlockFi, where you can use cryptocurrency to earn interest, borrow cash, and buy or sell crypto. If you want your free crypto, use the link in the description. It also helps out the channel. And if you'd like up to 2 free stocks, check out the link in the description to WeBull. If you open a new account, you'll get 1 free stock valued up to $250 just for opening an account. And if you fund your account with $100, you'll get a second free stock valued up to $1,600. Unless you don't like free stocks, that is. And if you're in Australia, the UK, or New Zealand, you can get a free stock with stake, also using the link in the description. Let's get back to it.
The battery space, battery pack systems for every cumulative doubling, and we're in very early days of electric vehicles, so we're going to see many cumulative doublings. Those costs drop 28%. So think about that. In the transportation sector, deflation driving a boom in electric vehicles.
Predictably declining battery costs is one of those things that should be fairly obvious to people within the automotive industry who aren't literally asleep at the wheel, but unfortunately, there's still companies out there today that are planning to have less than half their fleet fully electric by say 2030, 10 years time. I'm telling you guys, if you hear any CEO, president, etc. of an automotive company who doesn't plan to be fully electric before this decade is out, they will be bankrupt before the end of this decade. Mark my words. The cost of electric vehicles today is close, but not quite, at cost parity with an internal combustion engine vehicle. Never mind the lower cost of ownership, lower cost of maintenance, better performance, blah, 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 blah. The sticker price is almost at cost parity. If we run this into the future and factor in declining battery costs, remember the battery is the most expensive thing in the vehicle by miles, like by miles. If the cost of this continues to fall precipitously over time, that means the sticker price on electric vehicles is just going to plummet, meaning ICE vehicles are completely worthless. Ask yourself the question, what consumers out there, even the dullest of dull, would be willing to pay 10, 20, 30% more to buy a product that they know is going to cost them more to own, more to maintain, has inferior features, functionality, inferior performance, inferior safety, as I've talked about recently, having the battery pack, low center of gravity, and also a huge crumple zone because there's no engine at the front. I mean, literally, there's absolutely nothing at all going for internal combustion engine vehicles today except the sticker price. That's about to flip. And then honestly, you'd have to be an actual moron as a consumer to buy an internal combustion engine vehicle.
We're seeing the same in industrial robots. I think it's roughly 25% there. We're seeing artificial intelligence training costs drop anywhere from 37% to 50% per year. So, and artificial intelligence is going to permeate every sector, every industry, every company. And those companies not embracing it the way they should are going to lose out competitively.
I'm going to call massive understatement there from Cathie, lose out competitively, aka be put out of business by those companies that are embracing artificial intelligence. You guys may have noticed that software ate the world and dematerialized a huge amount of things over the last decade or two. When was the last time you bought a physical CD? DVD, Blu-ray, etc. Why would you do that when you can just stream? Well, artificial intelligence is going to have an impact orders of magnitude beyond that of software. Have a look at your own stock portfolio and ask yourself a question. Is AI a core component of the company, or is it becoming a core component of their future? If not, have fun losing all your money. Not investment advice, just me sharing my thoughts.
So we're very excited about that source of deflation because it will cause a boom. So that's a deflationary boom. We think that the ramifications of this good deflation are going to include creative destruction. the disintermediation or disruption of the traditional world order.
Remember I said Cathie Wood had an urgent warning for stock investors? That was it. Rewind, listen again until it sinks in.
And we think that roughly 50% of the S&P 500 is at risk of creative destruction. Some more, some less, but 50%.
The tragic thing is that there are so many investors out there today who've been brainwashed into believing that the S&P 500 is a safe place to keep their money, a safe, consistent, predictable place to store wealth and get a reasonable return over time. This may have been true in the past, but we need to reassess. Today, this is not the case. Cathie Wood is right. There's so many companies in the S&P 500 that will be extinct in the next 10 years. And so many vulnerable investors out there who just don't see what's coming. Imagine being somebody who's got the majority of their wealth in the S&P 500 thinking it's going to be a stable, consistent, safe return over the next decade, only to find out that half the companies they currently own in the index are out of business in 10 years' time. Talk about a recipe for suboptimal returns. In fact, I know there's many investors in the financial education space on YouTube who have huge amounts of their capital in the S&P 500. I won't name names, but I will say that these people are going to feel very bad about their investment choices in a few years' time unless they wake up and smell the roses. It is not going to be pretty. Cathie Wood is doing her best to warn investors about this urgently, and of course, Cathie Wood, crazy Cathie, just because she was right about Tesla doesn't mean she's a good investor. Anyway, I'm going to leave it there, but I'm doing my best to warn you guys. Hopefully you guys pass this message around too. There's a lot of people you probably know who have a ton of money in the S&P 500. Not going to end well, in my opinion, and also the opinion of Cathie. We both draw similar conclusions because we both understand what's around the corner. A huge amount of disruption and creative destruction, as Cathie called it.
And what does this mean? What we think is going to happen here for those companies who spent the last 20 years catering to short-term investors who wanted their profits and wanted them now, companies were leveraging up to buy back shares, pay dividends, and they were not investing enough in innovation. In fact, many didn't take seriously the idea that innovation was a threat. I know when we started ARC in 2014, auto manufacturers, auto analysts thought, this was something for the mid-20s, maybe. And we were looking at the cost declines in battery pack systems, and we were saying, nope, this is happening now. And now we see auto manufacturers scrambling, and we would say they're scrambling for dear life.
This is not hyperbole from Cathie Wood. I've been saying this from day one on this channel. The majority of legacy automotive manufacturers will not be in business by the end of this decade. They really are fighting for their survival, and most will be unsuccessful.
So we're going to see a lot of that in financial services, energy. So the two sectors that have done best this year, we believe, are two of the most vulnerable sectors. In the energy space, again, up 40% year to date. We think that electric vehicles, and especially autonomous electric vehicles as they launch within the next few years, are going to put a big dent in oil demand. It's at these times that if you do take a stand, differentiated from the crowd, for good reason, not just to be contrarian, the payoff can be enormous. And in terms of the recent behavior of value stocks, especially those that we believe are in harm's way, compared to the severe drawdown of innovation-oriented stocks, I like that setup very, very much. And just to finish on that note, we have a 5-year time horizon, as do most focused on long-term innovation. And in the middle of February, those strategies generally, according to our analysis, suggested that innovation would reward investors, again, if the analysis, top-down, bottom-up, of the possibilities associated with innovation are correct, would deliver a 15% compound annual rate of return over the next 5 years. Well, nothing has changed. Nothing has changed except the stock prices have come down. We're in bargain basement territory if our view on innovation is correct, the 5 innovation platforms. So if the return expected at the beginning of all of this was 15%, then the return expected now, again broadly, should be in the 25 to 30% range per year on average during the next 5 years. I love the setup, and we do think the bull market has broadened out, and we're looking forward to innovation joining the party once again.
So there we have it. A dire warning from Cathie Wood to stock investors. Be very careful where your money is. These so-called safe investments, maybe not so safe after all. And I also agree that there are some serious bargains in the market now. Some of these stocks that are coming back in tech, disruptive, innovative companies pulling back 20, 30, 40, 50% from their recent peaks makes absolutely no sense whatsoever. Nothing fundamental has changed about these companies or the technologies or the inevitable future. But of course, sentiment in the market has changed. If I didn't have a tax bill that was bigger than your girlfriend right now, I would be loading up with every spare cent. But unfortunately, I do owe quite a bit of money to the taxation office because the last time I was meant to pay my tax, I bought Tesla stock instead. And I also did that the time before. Yeah, that's right. 2019 dip, loaded up in Tesla instead of paying my tax. 2020 dip, I did the same thing. And I just can't keep kicking that can down the road any longer. Hope you guys have enjoyed this video. Let me know in the comments below if you're taking advantage of these huge bargains in the stock market at this point in time. What stocks have you been buying, loading up on? Have you sold anything as well? Let me know in the comments below. I'm Stephen Mark Ryan. This is Solving the Money Problem, and I love you all. And don't forget, if you'd like up to $250 in free crypto bonuses with BlockFi, use the link in the description. You can also get 2 free stocks with WeBull and a free stock with Stake, also linked in the description. Thanks so much for watching. Let me know your thoughts in the comments below. And of course, if you have any ideas for future videos, let me know. I read all your comments. P.S. If you're still watching, you're awesome. If you'd like early access, exclusive videos, regular Q&As, our private Discord server and more, consider supporting the channel at patreon.com/solvingthemoneyproblem so I can keep creating content for you guys. There's a link in the description. You can now also become a member of the channel for some exclusive perks. To learn more, click the join button next to subscribe. And don't forget to check out our merch store. Either way, the best form of support is you being here and watching, so thanks again.